Okay, ladies and gentlemen, let's talk a little bit about the cash flow statement. The cash flow statement is a report that shows how cash goes in and comes out of a company. There's two methods of showing and creating this cash flow statement. One is called the indirect method, and the other one is called the direct method. Now, there's three sections to a cash flow. There's operating, investing, and financing activities. And it's very important to note that the only difference in how to create a cash flow statement in the indirect and direct method is how operating activities are created. So what I'm showing you right now is really the operating activity section. The other point to note is the relationship between how things or transactions or accounts, really, to be honest with you, are affecting cash. And we're going to show you two methods. Let me write a few things down, and I'm going to show you a interpretive video by John Travolta. So look at the hand gestures and look at this action reaction. If this is an account, this must be cash. So let me just forward you this video and you'll see how John Travolta does cash. Now don't roll your eyes. Look at his hand movements. These are very important, ladies and gentlemen. You're watching the hand movements. In any event, we'll let the interpretive dance be another video, but you'll see here that the hand gestures are really important. One hand goes down, the other one goes up. One goes up, the other one goes down, and these have to relate to, right here, these are current assets. If an asset, current asset, such as inventory goes up, we're assuming that, for instance, accounts receivable, customers are delaying their payment. Indirectly, our cash account goes down. Another example of a current asset, inventory is purchased, it goes up. It means that we purchased inventory and our cash goes down. On the other hand, if inventory goes down, that means that we're selling inventory and cash is going up. Let's look at another perspective. Our accounts payable is going down. It means that we're paying off our obligations and cash is going down. It has the same effect on cash. Liabilities go up. Ladies and gentlemen, don't pay your hydro bill and you'll see that your bank account is kind of going up, or it's not diminishing. And so what you want to look at is an action reaction. Current assets have the opposite reaction. If something goes down, cash is going to go up, and vice versa. For liabilities, it has the same reaction. If a liability goes down, it means cash is going down, or vice versa. Now, what I'm going to do is I'm going to show you an example of how to do a cash flow in both methods. So you have this cash flow statement, and with all academic institutions, you got this comparative balance sheet and you have a current income statement. You also have a additional information, and from that we're going to create two types of statements. So what we're going to do is we're going to look at the following. Look at the change in cash. Our cash account is the report that we're creating. Our cash went down by $31,850. How is it going to do that? We're going to put things into sections. The first thing I got to do is I'm going to look at accounts receivable. It went from 69,475 to 91. It increased. So here I'm going to put effect on cash. This increased, so my cash is going down. Inventory, it went from 353,000 to 383,000. It also went up. So it means that my cash went down. It has the opposite effect. Prepaid expense, indirectly, it's going to affect cash. This went down, so our cash is going up. Now, all these current assets and liability accounts are going to be used in my operating activities. Now, for equipment and accumulated amortization, I'm going to put additional information. So these things, I'm going to look at my additional information for further clarification. Let's look at our accounts payable. Accounts payable went down. It went down by 39,900, so our cash is going down. Short-term notes payable has gone up. It means that we borrowed money. And long-term notes payable, it's gone up, but I'm going to put additional information here because it could be a combination of a few things. Finally, common shares has gone up to 63,000, and retained earnings, again, this is additional information that I need to look at. So I have, in the first step, looked at my balance sheet to look at the dollar change from one period to the next. I am then going to create for myself a set of journal entries for analysis purposes only. And the analysis purpose is to determine which accounts impacted cash. Let's look at the first journal entry. It says loss on sale of equipment is 7,175. That by itself is not going to be relevant, but the next point, bullet point number 2, it says equipment costing 65,625 with accumulated amortization of 39,375 is going to be sold for 19,000 cash. So those two bullet points are going to be important to me. Let me journalize it, and I'll show you which accounts are going to go where. I'm going to debit this cash account. This cash account, I received 19,075. I'm debiting a loss. This loss is 7,175. What else do I debit? I sold this equipment, so my accumulated depreciation is going to be 39,375, and I'm going to credit equipment. The equipment is 65,625. So the additional information has provided me with a bit of guidance as to what's happening here. Let me quickly add up my numbers. And you'll see that my debits and credits balance. Now, this cash account is going to go into my investing activities. Investing activities has to do with long-term capital assets or investments in other companies. I receive cash, and so it's an inflow. If I'm doing the indirect method, this loss goes into my operating activities, and this is an addition to it. The rest are irrelevant. Let's go back and take a look at another bullet point. The other bullet point says equipment costing $134,925 is purchased by paying cash and signing a long-term note for the balance. So By paying cash, that's my cash outflow, even though the equipment cost me $140,925. I just paid cash in that period of $35,000. Let's journalize it. You're going to get debit equipment. You're going to credit cash. And you're going to credit notes payable. And it's long-term note. So the long-term note is as follows. You paid $35,000 cash. The equipment was for $134,925, and this long-term note is the difference. And your note is $99,925. This $35,000 cash is a minus, and it goes in investing. So we've done the first 3 bullet points. We're going to go to the next bullet point, and it says we borrowed $5,250 by signing a short-term note. So we borrowed cash. And now, ladies and gentlemen, you'll see why that short-term notes payable is $5,250 on the balance sheet, that difference, and this is a short-term note. This validates that for myself, I put this as an operating activities. It's short-term, it's notes payable, it's a working capital account, and I put it in operating activities. We move back and we say paid $43,925 due long-term notes payable. So, ladies and gentlemen, we paid to reduce long-term note, and this is for $43,925. We're going to credit cash. This cash account will be affected in financing, and it's an outflow, and we're going to use that. A few more points. It says that we declared, we issued 3,500 common shares. 3,500 at $18 per share gives us 63,000. If you look back in your balance sheet, you'll see that the cash that was issued, the cash that was received is a result of the issuing of the common shares. Are we going to use that? Absolutely. This is going to go into financing, and it's a cash inflow. Last but not least, we're going to look at declared and paid dividends. When you declare dividends, you go debit dividends declared, credit dividends payable. And this is for $86,975. Do we use this? Is the cash account affected? No. But we debit dividends payable, and we're going to credit cash for $86,975. This is going to be financing. It's an outflow. So why do I do this? Because sometimes what we declare and what we pay is different, and I have to be careful about that. Everything I need is ready to go. I am going to look back in my cash flow statement, and I look at the fact that $31,850 is my target for the change in cash. And so in a few minutes, I'm going to be showing you both methods on how to solve it. 31 is my target, and I'm going to show you in 1 second how to do the indirect method. So here we are. We're doing the indirect method first. The indirect method is a bottom-up approach. We're going to start off with net income. Look in your income statement for $103,250. We're going to add back depreciation. In the handout, it talks about amortization expense. We're going to add back $26,250. Whoops. Now this is a cash flow statement, so it's not like an income statement, so don't get confused. In the income statement, losses are subtracted, gains are added, but and amortization is subtracted. But we're adding things back to reconcile to our cash balance. So losses are added back. Is there a loss on sale of equipment? $7,175. Then, ladies and gentlemen, this is the operating section. The operating activities. We got to look at any current asset and current liability here. We don't use the cash account, but we use the accounts receivable. Accounts receivable went up, so we have to subtract $21,525. Inventory went up by $29,750. So if inventory went up, cash goes down. My prepaid went down, so I add back $1,225. My accounts payable has gone down, and it's gone down by $39,900, and my short-term note payable has gone up by $5,250. So if you take a look, the indirect method provides you with data from the income statement, provides you with data on your current assets, and data from your current liabilities. I'm going to pause, I'm going to add these numbers up, and this is going to be my cash from or to operating activities. So I'm hoping that my addition's right, because this is my operating activities, and it's the sum of all the working capital, which is current assets and liabilities, my net income, and reconciling items. I now go to investing. The investing activities has to do with purchase of equipment, and sale of equipment, and how it affects cash. Those were the only two transactions that affected investing activities, and I'm going to go up and find that out through my journal entry. We purchase cash by paying $35,000. The note payable is irrelevant because we're doing a cash flow statement. And when we sold our equipment, we sold it for $19,075. So this is an inflow. From 35,000 negative and 19,075 positive, this is $15,925. This is cash from investing activities. So we've done that. Finally, financing. The financing activities are going to be a few things. We issued shares. $18 a share, and we issued 3,500. $63,000 of cash comes in. we paid dividends. We paid dividends, and that was for 86,975. We also paid 43,000 to reduce long-term note, and the long-term note payable is 43,925. Those are factors that affect the cash account. So my first draft, I'm not sure if I'm going to get this cash flow statement on the first try, and I'm going to see. I'm going to say 63,000. I'm going to subtract from it 89,975, and I'm going to subtract from it 43,925. And so 70,900 is my cash used by financing activities. I know that if I look back, 31,850 negative was my change in cash. Let me add up a few things. I'm going to add up 51,975, subtract from it 15,925, and subtract from that 70,900. And 70,900, I'm going to get 34,850. So I have to come up to 31,850. How much am I off by? I'm off by 3,000. So next comes my sleuthing abilities. I'm off 3,000. I got to go back and I got to look at something that I've missed. So the most common occurrence that happens in a cash flow statement is when you're under the gun in an exam, you're gonna be off. So the first thing you do is you go and check for reasonability. You add up your operating activities. Your operating activities, if you add it up, add them up again. Does this compute? Are you reasonable that you've looked at net income, your amortization expense, accounts receivable, inventory, prepaid, and your current liabilities? Yes. Sum them up again. Double check. I'm confident that this is the right answer. Then double check again. Look at your journal entries. Was there a purchase of equipment for cash? Yeah. And was there a sale? Well, you got 35,000. And you're going to add to that negative 35,1975. Yep, I'm confident that this is correct. Then do another reasonability. Let's add 63,000. Subtract from it 86,975. And then subtract from that 43,925. Ah, got it. So it's not really 70,000. You're under now exam pressure. It's 67. Add everything up. So this 3,000 was the result of exam stress. This is your change in cash, and now you're looking golden. Because I have this number and it matches the dollar change in cash, I can be certain that when I do the direct method, I am going to get the exact same figure in operating activities of 51,975 as I have done in the indirect method. So the next step we're going to do is the direct method. As I mentioned to you, the only difference between the direct method and the indirect method is how we showcase the operating activities. Operating activities are now categorized into 5 sections. The first section is cash from customers. We're going to add sales, and this is always going to be an inflow. Sales plus or minus any change in accounts receivable. In this case, we have our sales is 694,750, and my accounts receivable has gone up, so my cash is going to be affected by 21,525. The answer to the first one is 694,750 minus 21,525, and this number is 673,225. I'm going to do the same reasonability test afterwards if my operating activities don't balance, because the indirect method is going to assist me. The second section is going to be our cash to suppliers. In this section, I got to use one income statement account, cost of goods sold, and I'm going to add to it any change in inventory, and I'm going to add to it add or subtract any change in accounts payable. So my cost of goods sold, 350,000. It's an outflow, this section. 350,000. My inventory has increased, so my cash is going to be an outflow, 29,750. I now look at my accounts payable. It's also an outflow, 39,900. And I add these numbers up. They're all negative. So I'm going to get 419,650. This is a minus outflow. The third section is going to be all working capital accounts. Whoops. I'm going to call this cash for operations. I'm going to use my income statement information for other expenses, otherwise known as operating expenses, not total operating expenses. I don't want to put depreciation in there. And it's going to be plus or minus any other working capital accounts. Have I used prepaid expense? No, I'm going to put it there. And do I put short-term note payable in there? Yes, I do. So my other operating expense, 191,100. And I'm going to look at my prepaid. My prepaid went down, so I'm going to add 1,225 to it. And then I'm going to look at my short-term notes payable. It's gone up, so I'm going to add 5,250. The sum of this section is as follows. Minus 184,625. Last section, this is going to be cash for taxes. The cash for taxes are going to be my tax expense plus or minus any change in tax payable. There was no tax payable, so I look at my tax expense and it's minus 16,975. And this is where I get nervous. I'm going to add these numbers up, and it should balance up if I'm going to go back up 51,975. So I'm going to put 51,975 here as my baseline. Let's see if I need to go hunt for changes. I'm going to add 673,225, subtract 419,650. I'm going to subtract 184,625 and 16,975. I don't have to go chasing around anything because I have now balanced my operating activities in the direct method is the same as my indirect method, and this was a pretty good example of what to do when you find an error and you're not balancing. You find out, you do some reasonability tests, and then you go forward. So practice.